Welcome to Wealth Echelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control. The market's down and SCHD is slipping, but this is exactly when smart investors get rich. Read on to learn how Martin is turning a falling ETF into a profitable opportunity using 3 powerful strategies. When markets take a downturn, it's common to see fear and uncertainty take over. News outlets amplify the negativity, stock charts bleed red, and many investors feel pressured to cut their losses and exit their positions. But in every market pullback, there are those who stay grounded, people like Martin. At 38, Martin isn't just investing randomly, he has a plan. Recently, he invested $10,000 into SCHD, an ETF known for holding some of America's most reliable dividend-paying companies. While many are now questioning their investments in the face of SCHD's nearly 9% dip, from $27.78 to around $25.28, Martin remains calm and focused. He views this temporary decline not as a mistake, but as a rare chance to get ahead. Martin's approach is grounded in strategy, not emotion. He knows that real wealth is often built during downturns, not bull markets. That's why, instead of panicking, he's executing 3 smart strategies. First, he's reinvesting all dividends automatically. This allows him to accumulate more SCHD shares at lower prices, which boosts his compounding potential over time. Second, Martin is using conservative option strategies, like selling covered calls to generate extra monthly income, turning market stagnation into cash flow. Third, and perhaps most importantly, he's not backing away when prices fall, he's buying more. By following a value-averaging plan, he's increasing his investment during market weakness, acquiring more shares while they're cheap and lowering his overall cost basis. This combination of reinvestment, income generation, and disciplined buying positions Martin to benefit significantly when the market recovers. Rather than fearing the dip, he embraces it as part of a long-term journey. His strategy proves that even when an investment temporarily falls in value, smart moves can turn a paper loss into a future win. Martin isn't just riding out the storm, he's using it to quietly build wealth while others retreat. 1. Reinvesting dividends, while SCHD is cheap. Martin's first move, activating the Dividend Reinvestment Plan DRIP, might seem like a small step, but it's a core part of a powerful compounding strategy. Through DRIP, instead of taking his dividends in cash, Martin automatically reinvests them to buy more shares of SCHD every quarter. With SCHD yielding about 3.5% annually, his $10,000 investment is expected to generate roughly $350 in dividends per year, split into quarterly payments of about $87.50. Here's where the strategy gets interesting. When SCHD was trading at $27.78 per share, that $87.50 would buy him about 3.15 shares. But now that the price has dipped to $25.28, that same dividend buys around 3.46 shares. It may not seem like a huge difference, but over time, it adds up and accelerates his compounding. Martin is essentially getting more value for his money every time SCHD pays out. Why is this important? Because each additional share he buys increases the size of his future dividends. More shares mean bigger payouts, which then buy even more shares. It creates a snowball effect, where each round of reinvestment builds on the last. This is the essence of compound growth, earning returns on both your original investment and the income it generates. And when you're buying more shares during a dip, you're supercharging that process. What sets Martin apart from the average investor is his mindset. Many people panic when prices fall. They sell or stop reinvesting because they fear further losses. But Martin sees these dips for what they really are: discounts on high-quality assets. He's treating SCHD like it's on sale, knowing that temporary market declines are opportunities to build a larger, more income-producing position for the future. By staying invested and automatically reinvesting dividends during a downturn, Martin isn't just weathering the storm, he's using it to his advantage. Every lower-priced reinvestment improves his long-term returns. It's a patient strategy, and it doesn't require timing the market, just consistency and confidence in the fundamentals of his investment. Over the years, this approach can lead to significant portfolio growth, all without adding any new capital beyond that initial $10,000. That's the quiet power of DRIP, and Martin is using it wisely. 2. Selling covered calls for extra cash. Martin's second strategy, selling covered calls, is where he really starts to separate himself from the average investor. While many people simply buy and hold, hoping the market will eventually turn around, Martin is using a sophisticated but accessible option strategy to generate consistent income from his holdings, even while SCHD is down. Here's how it works. Martin owns more than 140 shares of SCHD thanks to his $10,000 investment and a bit of dividend reinvestment. Since each options contract covers 100 shares, Martin is eligible to sell at least one covered call. This strategy involves agreeing to sell 100 shares of SCHD at a specified strike price by a certain expiration date in exchange for an upfront premium. Essentially, someone pays Martin for the right to buy his shares later at a set price. Let's break it down with numbers. Say SCHD is currently trading at $25.28 per share. Martin sells a covered call with a strike price of $27, set to expire in a month. He receives a premium of 90 cents per share, which means $90 in cash up front just for writing that option. If SCHD remains below $27 at expiration, the option expires worthless, and Martin keeps the full $90 without giving up a single share. He can then sell another covered call the following month, essentially renting out his shares for extra income. But what if SCHD rises above $27? In that case, the buyer of the option will likely exercise it, and Martin will be required to sell his 100 shares at $27 each. That might sound like a loss since Martin bought in at $27.78, but don't forget, he also received the $90 premium, which offsets the difference. And if SCHD's price recovery was quick, Martin may have collected dividends or other premiums in the meantime as well. Even in this scenario, Martin walks away with cash in hand, no panic, and possibly a new opportunity to re-enter at a better price. What's powerful here is that Martin isn't just holding on and hoping. He's actively generating cash flow every single month, regardless of whether SCHD goes up, down, or sideways. Over the past 2 months alone, he's already made, which brings his passive income $180 in options income. On top of the $87.50 quarterly dividend to nearly $270 in just a short period. This income-focused approach gives Martin a huge psychological edge. While other investors are nervously watching prices fall, Martin is staying calm because he knows he's still getting paid. Covered calls are especially effective in a market like this, where prices are range-bound or slightly declining, which is exactly what SCHD has been experiencing. Of course, this strategy isn't without trade-offs. If SCHD were to suddenly spike above $30, Martin would have to sell his shares at the $27 strike price, missing out on some upside. But that's a trade-off he's willing to accept for the steady cash flow and downside cushion it provides. It's about managing risk and turning volatility into opportunity. 3. Value averaging to buy more during lows. The third part of Martin's strategy is perhaps the most contrarian. He's using something called value averaging to invest more as SCHD falls. Unlike dollar cost averaging, DCA, where you invest a fixed amount regularly, value averaging, VA, involves investing more when prices are low and less when prices are high. Martin has committed to growing his SCHD holdings by $1,000 every quarter, but instead of investing a fixed $1,000, he adjusts the amount based on performance. For example, if SCHD performs well and his portfolio is ahead of his $1,000 quarterly growth target, he invests less. But if SCHD drops and his holdings fall short of the 1,000 growth benchmark, he invests more to catch up. This quarter, because of the price drop, Martin's portfolio is $350 below his expected growth target. So instead of investing $1,000, he's putting in $1,350. Why? Because he's buying more shares at a lower price, which helps rebalance the portfolio and positions him for greater returns when the market rebounds. Most people shy away from buying more when prices are falling. But Martin knows that volatility is where wealth is made. He's not buying blindly, he's buying strategically, following a disciplined plan. This allows him to lower his average cost per share while building a larger position in a fund he believes in. Over the long run, this approach will result in a portfolio that grows faster and recovers quicker than one built on emotional decisions. The bigger picture: why Martin isn't worried. You might wonder why Martin remains so confident in a fund like SCHD even as its price declines. The answer lies in his deep understanding of what SCHD represents. This ETF isn't built on hype or speculative growth. It's composed of high-quality, dividend-paying U.S. companies such as PepsiCo, Coca-Cola, Verizon, and Texas Instruments. These are financially sound businesses with long-standing histories of not only paying dividends, but increasing them steadily over time. The recent dip in SCHD's price isn't a reflection of these companies falling apart. Rather, it's the result of broader macroeconomic challenges and short-term market sentiment. Martin sees past the noise. He knows the fundamentals remain intact, and SCHD continues to generate reliable income. That's why he's not attempting to time the market or chase trends. He's sticking to a disciplined approach focused on long-term growth. By reinvesting dividends, to accumulate more shares, selling covered calls for added income, and using value averaging. To buy more during downturns, Martin is turning volatility into opportunity. His calm, strategic mindset sets him apart. While others react emotionally, Martin is steadily building wealth through a smart, systematic plan. What you can learn from Martin. Martin's success during the SCHD downturn isn't the result of luck or wild speculation. It's the outcome of a disciplined strategy and long-term mindset. While many investors panic at the first sign of red, selling off their assets and locking in losses, Martin takes a different approach. He remains calm, focused, and opportunistic. He understands that market declines are not disasters, they're opportunities. Instead of selling in fear, he reinvests his dividends, sells covered calls for extra income, and buys more shares through a value averaging strategy. With just a $10,000 investment and a clear plan, Martin is earning consistent cash flow and positioning himself for stronger returns when the market inevitably recovers. His actions demonstrate that you don't need to be a professional investor to succeed. You just need patience, a solid strategy, and the courage to stay the course. Market volatility will always be part of the journey, but investors like Martin know that those who stay disciplined during the dips often come out far ahead. So the next time your investments take a hit, don't react with fear. Instead, ask yourself, what would a smart investor like Martin do? Chances are, the answer is to stay the course and lean into the opportunity. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.